What I'm going to talk about in this video is a different way of utilizing sensitivity analysis. So when we do sensitivity analysis, we can do a lot of trials, and the trick is presenting it to management in a format where it's easy to understand. So let's look at a little model that I put together. Now this could be the project model, but this is a project where we have an investment of $100,000. We're going to depreciate it over 3 years with maker's depreciation. Very simple. We have we're going to make 4,000 units a year, $100 per unit. Unit cost $92 a unit. We've got a tax rate of 25%, and our discount rate, our present value factor, is 12%. For the time being, let's assume our life is 5 years and we have zero salvage value. That makes things real easy. We don't have any tax impact upon disposal of the asset. Now I'm going to post this presentation on this Excel spreadsheet, but I'd like you to look at how I deal with the recapture amount. So we're going to depreciate, we're going to recapture our salvage value. We're going to depreciate to zero, so there's no salvage value tax impact. And so I've split out my salvage value, and then I've split out my taxes on salvage value. Let's say that I had $1,000 salvage value. So this is just kind of a what if. So instead of zero, $1,000. What I have is I have a book value of zero at the end of year 5. I've calculated over here a recapture amount that we have to recapture is $1,000. That's the difference between the salvage value and the book value. This could be at any point in time, so we could have this happen if this was a 10-year makers at the end of year 5. We could have it's going to be the difference. So we're going to get the cash of $1,000, and then I'm treating our normal income and expenses separately than my salvage value. And so if you notice here, if we look at this taxes on income excluding salvage value, if I make this a 0, that column doesn't change. The column only changes, or the dollars only change in the taxes on the salvage value column. Just a little clearer way to put this, I think, to help you with the understanding. But let's go back to our base case here. And so what I have is I have a small little model. I've got a before tax internal rate of return of 18%, after tax internal rate of return of 14%, 14.3%, and the present value of the project at 12% of $5,580. This is greater than zero. It's a good project. These are our performance variables. That is, this is what management is most interested in. So when we do sensitivity analysis, we want to test the sensitivity of one performance variable or the other. Now I'm going to test it on present value, and I'll explain why in a second. So let's consider what is going to be a driver here. We don't know how many units we're going to make a year. We may not know the unit revenue. We may not know the unit cost. So we will test the sensitivity of the present value to these 3 variables. Now I've shown you about data tables in the past, but let's look at the data table right here. I'm looking at the unit price, and I'm going to vary it from minus 20%. Okay, we have $100, minus 20% to plus 20%. And the way we do this, let me just delete this here. I can hard code these numbers in. It's important that you don't refer back to this cell because it'll mess this up. This is the performance variable, L21. right there. And so these are hard-coded in, and basically what I do is I highlight this range. We go into data, what if analysis, data table. This is only a one-way test, so we're going to input the column cell, and this is our unit price cell. I'm sorry, unit revenue cell. I said unit price. I'll correct that. And this populates this. This is the present value of, and it makes sense, right? If we have $80, we're basically losing $12 a unit. And so we're going to have a negative net present value. $100 is our base case. $120, we've more than, our net profit has gone basically from $8 to $28. So our net present value has gone up quite a bit. So I've built a data table with a table of present values by changing the unit price plus or minus 20%. I've done the same thing here for the number of units. And so if we have 32 units a year, we have a negative present value. 4,800 units a year, positive present value. And I've done it for the unit cost. This is what it looks like here. Now I've had to keep them separate, but this is what I've done here below. This is my percent change in the variable that we're testing. And what we're testing in column 1 is unit price. In column 2, unit cost. Column 3, number of units. And so I'm saying if I drop my unit price by 20%, my NPV is negative 200,000. If I drop my unit cost by 20%, my NPV is 196,000. And if I drop my number of units by 20%, my NPV is negative 11,000. Notice at 0, this is our base case. And so what I want to do is I want to plot this. So let's look at what we can do here. We're going to insert a chart. We'll make it a scatter diagram. And this is what we have here. And let's interpret this a little bit. So what we find here is this is the magnitude of the net present value. Say a spider plot where you are working on percent changes will always cross at the origin. Now, well, it's not the origin. The x-axis will be at the origin. The y-axis will be somewhere on the, this happens to be very close to 0. It's 5,000. That's why it looks at the origin. Couple things to interpret here. The initial one is you don't want too many lines on a spider plot. I've got 3 lines on this spider plot. The next thing we want to look at is the slope of these lines. Now it's clear that the number of units, this is the gray line, has less of an impact than obviously the unit price. So if there's things you can control, you want to try to control the things that have the greater slope. But what I want to talk about next is this is one way to look at this, and this gives you magnitude. And you can do this with internal rate of return. But I think what's really powerful is looking at the percent change in net present value. Okay, so let's look at this. Let's do another table here. So we're going to copy this down to here. And what we're going to do is make this the percent change in net present value. Okay, and so let's just, I'm going to hard code this in, but you can make this a variable, but this is going to equal this value minus 5579 divided by 55.79. Let's make this a percent. Now recognize that this is a canned problem and this number is unrealistic. But basically what we're saying is the interpretation is a 20% drop in price gives you a 3,722% drop in present value. And a 20% increase in price will give you a corresponding increase in present value. Now we can drag this across here. We're going to get similar numbers for unit cost. And the important thing is recognizing the difference in these percentages. And we can plot these if you want to. So what we can have is percent changes, but the interpretation is that the changes in unit price and unit cost have 10 times more impact than the changes in number of units. So if you can do things to control your cost, reduce your costs, that's more important than slightly increasing or slightly decreasing your units. And so we'll copy this down to here. And by the way, if this was a real world problem, what I would do is I would make these changes a little bit smaller. So maybe go, from -10 to +10. And notice that the extremes are the same. And it's because when I say extremes, the -20, +20, -10, +10, the magnitudes are the same. That's because we're dealing with present values. I like to do this with percent change in net present value rather than percent change in after-tax rate of return, because it's hard to wrap my head around what does the percent change in a percentage actually mean, and it's a lot harder to explain in a meeting. So let's graph this. We're going to get a similar outcome as above, but there's an interpretation that's a little bit easier to see. And I think that it's easier to see with the number of units. Obviously, these percentages or the magnitudes of them are ridiculously high. But we could say a 10% drop in the number of units gives you a 150% drop in the present value. Or a 10% increase in the number of units gives you a 150% increase in the present value. So that's kind of the interpretation. So the takeaway from this video that I would like you to have is, number one, you want to build your projects with as much variability as you can. And so you want to enter data one time. It all gets referred to from this table right here. I showed you how I deal with recapture with salvage value. We can do sensitivities on tax rate. We can do sensitivities on investment. The thing about this is the investment may be the one thing you're most sure of. The tax rate is one thing you can't control. A lot of students like to do sensitivities on interest rate. That's fine, but recognize that most companies have their own interest rate. So you're not going to be going into senior management and say, hey, this is a great project. We just have to drop our company's interest rate from 12% to 10%. So that's the one thing I want you to take away. The other is spider plots can give you an awful lot of information in one slide. And you don't want too many lines on the spider plot, but you can compare slopes. And the ones with the greater slopes are the ones that have a bigger impact, with changes have a bigger impact on your performance variable. Performance variable is either after-tax net present value or after-tax internal rate of return. So this is another tool you can use in analyzing your project with sensitivities. I believe this is a tool, if you put it together properly when you start working in industry, it will help separate you from your peers when you make presentations to senior management.